Record button. Whoops. All right, cool. Now let's talk about companies. So companies pay tax at 30% or 25%. Now there's two rates because a company who pays 30% tax is going to be an investment company. And I'm talking generally here. A company that's paying 25% tax is in some sort of business. Now, trading crypto can be a business. Keep that in mind as we talk about it later. Cool. Tax planning. Yes, there's way better tax planning outcomes with companies, especially when we look at who owns the shares in that company. That's important. And then the last one there is asset protection. So again, a well-structured company can protect your personal assets. Now, if we look at trusts, we've got a 0% tax rate here. It's a little bit misleading. The idea is that trusts actually give their profit to the beneficiaries, which is usually other family members in the family group. And then they pay the tax on the trust's behalf, if that makes sense. So how that would work, let's say you make a crypto gain in your trust, you can choose who that's spread between over your family group versus let's compare that to a sole trader. You make a gain as a sole trader. There's no distribution available. You got to cop that hit all in one. And yeah, again, we've seen some pretty hectic wins that people have had with crypto. But again, if it's not set up from the start before you make that investment or before you're running that business of whatever you're doing in crypto, you're sort of stuck until you change. So cool. Yeah, tax planning and asset protection. Again, trusts are great for that as long as they're set up right. And then we go over to SMSFs, which is another way that actually many of our clients with SMSFs actually use a portion of this SMSF for crypto, which is legal, possible, can do it. And the way that works from a tax rate perspective is as you're accumulating your balance throughout your life, you get taxed on your profits at 15%. Now, if you make capital gains in super, where you own that asset or that thing, that crypto for more than 12 months, then you pay capital gains tax at 10%. So you get a 5% discount. Now, that 0% tax rate, that's legitimate, but that's when you're in pension mode, which means you've hit a certain age and certain conditions where you're able to access a tax-free environment in super. You don't need to go to the Cayman Islands or hide your crypto account to access a 0% tax rate. So it is possible there, but again, meeting those certain conditions. Now, tax planning, SMSFs get 2 ticks because it's such a good tax environment. Again, all we have to do is look above at the tax rates. And then when we look at asset protection with SMSFs, they also get 2 ticks. The reason because is they're actually protected in the case of bankruptcy, as long as you haven't gone and chucked a heap of money into super real quick, knowing something bad is going down. But yeah, you can actually survive being personally sued and losing all your personal assets without them coming after your super. Again, if you haven't done the dodgy about it. Cool. Now, that's a bit of an overview on the structure options available to you. And maybe I just want to ask a question. If you type in the chat box for me now, what structure do you have your crypto in now? Is it sole trader? Is it sole trader and a bit of SMSF? What is your structure? Cool. So we got SMSF company. Let's see if we can get a word cloud going. No, that's not going to work. Sole trader trust and SMSF. Awesome. Cool. All right. So there's actually a bit of a mix out there, which is kind of cool. Trust and company. All right. And BVI, Cook Islands, Steve, you were on to it, hey? That was a direct message. No one else saw that. And I bet you didn't expect me to read it. Steve is my resident heckler, if anyone wants to know. All righty. So the next one here is tax rate. So we've talked about conceptually the structure that we've got going on. Oh, there's me slides. Now, when we talk about individuals and 47% tax or up to 58, if it's really bad, we're talking about marginal tax rates. So the more you earn as an individual or a sole trader, the higher the percentage tax you'll pay. These are the rates, and it does not include the Medicare levy of 2%. So keep that in mind as well. So let's say we're looking at 120 grand here. That's about 30 grand in tax. And anything above that, up to 180, is 37 cents in tax plus 2% Medicare levy. So 39% effective tax rate. So keep that in mind. Again, we've seen people have massive wins gains with crypto and just been smashed with tax. So again, structure is key. Now we're going to shift gears and talk about the concept of revenue or capital when it comes to crypto. Now, this is a concept that applies not just with crypto, but share investments, other investments, and even when we look at certain business transactions as well. So it's not a new thing when it comes to crypto only. It's something that as accountants we deal with day to day. Now, what the idea here means is whatever the earnings are they on revenue account or capital account? Now, what we mean by revenue account is it's normal business income. It could be trading income. So if you're trading crypto, including bots. And what we're looking for there is volume of transaction. And there's no legislated number of transactions that tick you into this revenue versus keep you out. But it's sort of, when we're looking at trading, it's usually pretty obvious of people in there, doing a handful of trades every week, keeping an eye on stuff. Then we would ordinarily see that as revenue on a revenue account. Mining. So the mining that I did, I was earning little tiny bits of Bitcoin every hour, and the transactions behind that were ridiculous. But anyway, the point is that mining income is an example of revenue account, not capital. So when I receive that income, it's not a capital gain, it's revenue. Similarly, income from staking as well. Now, tax is paid on income, less the expenses to derive that income. So in my mining example, I could claim the electricity associated with running that mining rig, all the repairs and drama associated with it as well. Pity I can't claim the opportunity cost to the muck around, but anyway, so tax is paid, remembering, on income, less associated expenses. Cool. Now, if we switch gears to, here we go, to capital. Now, what we're talking about here is examples of capital would be a hodling, buy and hold for the longer term. And again, the intention is a key part of when we look at either revenue or capital. But the intention is to profit over time on an eventual sale. So buy and hold, you kind of would tick the box of capital. You're allowed a discount on the gain if it's held for more than 12 months. So you buy a Bitcoin now, you sell it in a year and 1 day's time. That would be an example of being a capital gain and or loss. So tax is paid on the sale value, less the cost base, adjusted for any discounts if you're eligible for them. So that's that one there. Cool. Now, what we're going to do is apply that now. And I'll check questions. Thanks, Daniel, for that one in a moment. Cool. So revenue example for tax. So Bob trades crypto and makes $1 million profit. Doing pretty well. Bob also works and earns a 120K salary as an employee. Now, tax just on the crypto profits are either, as a sole trader, you lose almost half of that in tax. As a company, if it was structured as a company, Bob would pay 250K in tax. So that's a pretty big difference. So tax saving, if it was a company in revenue account, you're looking at $215,000 in tax savings. There's an example of the concepts we've spoken about applied. Now, generally, this is your outcome. And I say generally because, let's say hodling, intention is to hold, not trade. If you were hodling and then all of a sudden you switched into trading like mad, that would change the outcome there. Mining, again, commercial, business activity, trading, intention to profit from activity, not long-term gain. NFTs, unless you're creating them, we had someone who was creating them. But if you're just buying and holding them, then we're looking at capital. But if you're trading NFTs, again, we fall back to revenue. Staking, and I feel, Josh, your question about airdrops falls under this one here, revenue account, for airdrops as well. Cool. Alrighty. So how do you reduce your crypto tax? The first thing is know the rules, which we've covered a bit of, and I'll go into some mythbusters shortly. The second one is get on the front foot. Don't bury your head. So this sort of stuff, and especially when it comes to record keeping for crypto, it's immense. I've gone through the process of doing my mining and then picking up the pieces when it came to record keeping and reporting. It's a mess. There's software available that can make light work on it. And again, the more you do before you go and see the accountant, the less they're going to charge you as a result. So keep that in mind, that we want you to be using things like Crypto Tax Calculator or Coinly. There's a few out there that make light work of reporting. Sometimes the exchanges or the platforms that you're using don't report exactly how we need to see it. Or they're having a crack for a US customer base, not necessarily Aussie. So keep that in mind. The next one is get your structure right. From the start is best, but the second best time to get your structure right is right now, to make sure your future profits are earned in a tax effective way. And then the other one there is do tax planning with a good accountant. So we're actually coming into tax planning season at Inspire. So again, our client base is business owners. Yes, some of them do have crypto portfolios. And the idea is that if you've got gains or things that you crypto related, the idea is that you want to make sure you're planning for your tax outcome, not just trading, selling it, doing whatever, and then it turns out to be a massive amount of tax that you weren't expecting. So planning is the key. Report accurately to avoid fines or penalties. Yeah, I mean, I'm not an expert in this stuff, but what I understand about crypto is you can trace wallets and see where money's going, and it's all public. So at the end of the day, I wouldn't try to hide it. Be up front, play by the rules, and then you'll reduce your chances of fines and penalties and other dramas. If you're trying to make it look like something it isn't, that's when you need to be worried about it. So what I mean by that is if you want it to be capital because you get a discount, but it's not capital, just let it go and get the right advice on making the call between whether it's capital or revenue. Yes, you might get a 50% discount if it is capital, but again, we can't, if it's not capital, it's not capital. The end of story. So just keep that in mind as well when you're going to do your reporting. Sweet. Yeah, I mentioned this earlier. So some exchanges have great reporting if that's all you have, but often people have multiple different places their coins are. And again, there's specific crypto tax apps, Coinly, Crypto Tax Calculator, Coin Tracker. And yeah, the fee for that sort of thing is way cheaper than accountant, downloading your CSVs of all your trades and then sending that to the accountant. Cool. All right. I might just stop and just double check my questions here before we get stuck into crypto myths. All righty. So what if you combined mining and holding, mined, then held for a couple of years, then sold? So Daniel, just I guess generally the mining income would be on revenue and your holding income would be on capital if that's the outcome that you had. So it's both, not just one or the other. Howard, there is no income earned on crypto accounts. Yeah, I don't know about that. Because I guess, yeah, you've got staking, you've got mining, you've got airdrops. There's ways that you can earn income, so to speak, on your holdings. So you've said how could they be considered anything else but trading? You buy and hold them basically. So you buy a Bitcoin, hold onto it, and you sell it later. If you're not trading, that'd be on capital. If you've made losses, don't forget you need to turn over 20K. Yeah, there's commercial loss rules. That needs to be considered. Absolutely, that's probably a bit too detailed for what we're going in now. But again, that's something if you'd be on revenue basis. Axel, what are the implications of the FTX Celsius cases if we had holdings with them? So that's pretty complex, and I'm pretty sure that is undecided at the moment. There's recommendations out there, but it depends on what exchange you held it through, how you lost the FTX related losses. But I think we had someone in January. We had an SMSF that made a loss through that. So I don't know from the top of my head, but there's like a guidance for now, but I don't know that I've seen the ATO go, here's what you do, unfortunately. So we can make conservative what we think the approach should be. But yeah, if that's the case, Axel, then I'd recommend having a chat with someone to get that. Yeah, that falls into the specific advice-y bit. Cool. Alrighty. No other questions I can see. So what we're going to get into now is our crypto myths. Alrighty. Crypto tax myths, maybe. I'll only pay tax when I convert it to Aussie dollars. That is wrong. So that's probably one of the biggest myths. Is only when I pull it back out to Aussie, then I'm taxed. Cryptocurrency is like a currency. It's literally like, in terms of from a tax lens, it's like going and exchanging your money to Japanese yen and then transferring your Japanese yen back to Aussie dollars, or transferring it from yen to rupees or whatever it is. But the moment that you sell your other currency is another taxable event. So if you go from Aussie dollars into Bitcoin, into Ethereum, when you sell your Bitcoin for Ethereum, that's a taxable event. So do keep that in mind. I even gave him a Japanese yen example. Forgot about that. Cool. So I hope that's clear. There's really not a lot of depth to go in there, apart from it's not just when you pull it back out to Aussie. Crypto tax myth number 2. If I make a gain but put the money into another coin, I delay the tax bill. Again, that's incorrect. It sort of just follows on from the example before. When you sell your Bitcoin for Ethereum, you're disposing of Bitcoin and buying Ethereum. They're seen as two different events. There are certain events when it comes to running a business, such as you selling the business, where you can roll the gain over into something else, but they're small business capital gains tax concessions and nothing to do with general capital gains tax events or trading income when it comes to crypto. Alrighty, crypto tax myth number 3. I don't have to pay tax because the ATO will never know about my portfolio. That's super dangerous. And then the other thing down here is, when I hear people talk about cashies and stuff or trying to hide stuff, there's a sleep at night tax. I feel that people pay for that. I'm not here to be moral guidance for you, but I can tell you it's just not legit. You do what you need to do, but it's wrong. Crypto tax myth number 4. My crypto is a hobby. Ooh, I've heard this one a couple of times. Thanks, Howard. So my crypto is a hobby, so I don't have to pay tax. So there was some guidance around this from the ATO, thank goodness, that it's personal use if it is kept or used mainly to make purchases of items for personal use or consumption, buy clothes, music, games, not to sell or trade in. So again, if they look at the activity, the intention, if you've made a heap of money off crypto, it's unlikely that it's going to be seen as personal use. Here we go. Intention to use to purchase income producing investments. You intend to keep it for a number of years with intention of selling at an opportune time based on favorable value. Crypto myth number 5. My SMSF cannot invest in crypto. That is also a myth. No laws prevent it. Read your trust deed or your SMSF trust. An SMSF is a type of trust. That's why I'm using the words trust deed here. If it doesn't include the ability for it, the trustees can amend the deed to allow it. The investment must meet the sole purpose test, which is basically only used for your retirement. But let's say you used your SMSF funds and got a benefit personally. Let's say, I don't know, you got staking income sent to your personal. That's a breach of the sole purpose test and a naughty one from an SMSF perspective. You cannot acquire crypto or any assets apart from a certain couple from a related party. So what that means is if you've got a handful of Bitcoin outside of super, you can't just transfer it in as a contribution. You need to consider it in the investment strategy. So again, it needs to be documented, make a decision on it as a trustee, and it needs to be owned in the SMSF. So I can't just go and set up an account under Ben and then just in brackets write my SMSF stuff in it. It needs to be set up properly. So there are exchanges who do set up SMSF exchanges in Australia, and then you transfer from wherever your SMSF funds are in a bank account to that exchange. And when you get a report from that exchange, it's showing very clearly that the account holder is your SMSF. So if that's not the case, it's probably not been done correctly. Keep a very good record. Your SMSF is audited. So if you are doing this stuff, again, we want to make sure it's really well documented. You're getting those reports saved and downloaded every year at least. And of course, your accountant or whoever's looking after your SMSF compliance and admin will want to see those reports and be able to record it on their end. So do keep that in mind. Alrighty, how are we doing? Geez, we blitzed through it. So we do have time for a couple of questions, but we're finished the content that I had intended to cover. Now, if you're working with us as a client, again, the next step, if you do want any more advice around this stuff, then please reach out to the accountant who you work with at Inspire and say, hey, just was on Ben's crypto webinar. Can you please help me with XYZ? And we'll let you know the next steps there. Now, if you're not working with us, but you want to talk about structures and getting companies or trusts in place, whether it's the right thing for you, then the next step on that is what we call a structures and strategy session. So it's a 60-minute session that we go through. We go through all the different options, your personal situation, and even not just your crypto stuff, what you're doing outside of that. Are you like Bob and you've got a job separately, or do you run a business? What is it that you do, and how would that impact your crypto earnings and profits and capital gains? Our price for that session is 750 plus GST. And if you do want to explore that, the thing to do right now is write SSS. It's a bit of a tongue twister, but structures and strategy session in the chat box. Our team will pick that up and then reach out to you just to double check that you still wanted that session and to book in a time for that. So again, SSS in the chat box will mean that our team will see it and pick that up and reach out to you about booking in that session. Oh, cool. I forgot even to mention my emojis. So if you find the reactions button down the bottom in Zoom, you can see all the things fly up on my screen. But anyway, a bit too late for that. But cool. I can see a couple of SSSs in the chat box. Very cool. Sweet. Well, yeah, I'm happy to stay around for a few minutes to take any questions that I can help with. Apart from that, that is all I had to cover today. So again, appreciate everyone making the time, joining in. I hope that was quite helpful. And Carol has asked, can we get the recording? Yes, we will be sending that out this morning, well, after it converts into a Zoom recording, and we're good to go. About to do my SSS, looking forward to it. Sweet. Alrighty, no worries. Andrew's asked, if you purchase an NFT with a plan to receive additional NFTs as airdrops, what do you pay tax on? Oh, like Inception. We'd probably want to give you a bit more guidance than this, but I would imagine if you own an NFT and then you get something as a result of that, that something as a result would be income, but your original purchase of the NFT, if you're not trading it, that may be on capital. So again, we've kind of got a bit of both, and this is why this stuff gets way complex. But that'd be my shoot from the hip answer. A bit of both. Cool. Thanks, Stephen. Hey, Luke, it's good to see you, mate. Hope you've been well. Cool. What about wrapped tokens? Josh is asking from Bitcoin to W Bitcoin. I do not know, but the way generally we look at this stuff is if you've got an asset and you change to another asset, that is an event, a CGT event, or a taxable event. Yeah. So the keywords that you've used in your thing is different token. Andrew, do you pay tax on the Ethereum, for example, or once you sell it into Aussie dollars? So if you sell, it depends on what you're selling your Ethereum for. So if you sell Ethereum into any other coin or Aussie dollars, that's a taxable event. But if you get, what are you saying? So you see, so Andrew, I might sort of spotlight you for a sec. So you're saying you bought an NFT and you get Ethereum as income. Cool. I might need you to maybe nod your head. I can see you in the gallery. Yeah, cool. Okay, so you get Ethereum. Then that Ethereum, if you dispose that to Aussie dollars, is that taxable? The answer is yes. But your Ethereum initially that you receive from owning the NFT, that would be taxable as income. And then you'll also have a cost base, so that Ethereum will have a value to it. So let's say you got allocated 10 grand worth of Ethereum, and then you transferred it out to Aussie dollars for 11 grand. Then you're not going to pay tax on the 11 grand again. It'll be just that $1,000 gain or difference. Alrighty. So I got a handful of questions here. Sweet. Yep. Joe. Yes. Lots of scams and phishing and all sorts. Phishing with a PH, not a F. Cool. Thanks, Louise. What about staking tokens? Oh, it's all just Ethereum. Okay. So Josh, going back to my staking. So basically, I remember staking in a platform where I had to put it in a staking area, but it was still Ethereum. Where are you, Josh? There we go. Cool. Thank you. So still Ethereum, and you're earning staking income off it. Is that your situation?
Can I just talk? It's easier.
Yes. Yeah. Perfect.
I'm just saying, if you go to stake ETH, then you need to hand over your ETH, and you get back another token, which is the staked version of ST ETH. So you're not actually getting rid of ETH. You're just, in order to earn yield, you need to give up your ETH to the platform. The platform gives you back another token, which is like a contract saying that they have your ETH and that you're eligible for it back. You're not actually disposing of ETH, but the only way for you to actually participate in staking is to hand over your ETH to the smart contract. And then the smart contract gives you back a receipt saying that you've done that, in the form of, if we're talking about Lido, it'd be like ST ETH, or if another staking platform will have their own version of this like receipt, but it's not actually disposing of your ETH. You're just, to participate in staking, you need to do this. But is this seen as disposing of your asset and as a taxable event? Because if it is, then there's no incentive to participate in staking at all.
Yeah. Yeah, no, I see the dilemma quite clear now. The answer is I don't know. It'd be pretty rude if the outcome is that moving it into the staking section means that you cop a tax hit at that point and then moving it back out. But again, it's not whether we like tax rules or not. That's what they are. I don't. Yeah, I just don't know. I'd have to look into that one. Sorry, mate. Yeah. Just going through some other questions. Elliot, any good old tax department? Yep. Just double checking. Does transferring crypto between your own accounts still trigger a tax event? Andrew, no, it doesn't. So if you send Bitcoin from one wallet to another, you still own that Bitcoin. It's just in a different wallet. If you trade and each trade is a tax event, does each loss event count as an offset? Yes, absolutely. So you got some wins, some losses. There's a couple of things to keep in mind. So when we're looking at a financial year, the key with that is we want to make sure that your gains and your losses offset each other, but only within that financial year. When we look at sorry, the other thing is what happened a couple of years ago when we had that big crash is people had made massive wins, massive gains for a year or two, and then they hadn't paid the tax on that yet. So then, the value of their portfolios has dropped massively, maybe halved in some instances. You throw an FTX crash in there, ouch, even more. And then you've still got the tax bill from the gains you made previously, even though you've got a loss in this current financial year. Unfortunately, we can't go and retrospectively apply losses back to those gain years, which again sucks, but it's the way of the road. So yeah, keep in mind we can't make a loss now that then we write back then. Daniel, your question about you've got stuff in personal, should you do it to trust? That's the sort of stuff we answer in an SSS. Joe, sometimes the asset is kept in your own wallet for staking. Is it transfer? Yeah, I'm not sure about that. Sorry, Joe. Josh, what about tokens that are subject to a freeze? Well, Josh, I think we just look at what event you're concerned is the taxable outcome there. So at this moment, it goes into the freeze. I'm just not sure. Maybe it's situation dependent on that. But when it unfreezes, you've still got that coin. So I don't know that, like, the unfreeze, I wouldn't imagine would be a taxable event. It's any sale or any trade after that point. Q Andrew, to circle back, if I own an NFT, then I get airdropped another NFT that I continue. Airdropped NFT for 1 Ethereum. Okay. So you bought NFT 1, you get airdropped NFT 2. This is shooting from the hip. So NFT 2 you get taxed on when it's airdropped to you under revenue account. Then let's say you got it was valued at half an Ethereum, and then you got 1 Ethereum 13 months later. But you held it NFT 2 for that long. That hold of the NFT 2, subject to specific stuff, I would imagine is on capital account when you sell NFT 2. And an NFT 1 you purchased for a cost base. So when you go and sell that one, that's probably going to be capital if you've held onto it. Axel, can crypto losses only be offset against crypto gains? So no, Axel. It depends on what type of loss it is. So if it's a trading loss, then we're subject to the trading loss rules, which could be even against your other personal income, depending on whether the crypto stuff, the trading that you're doing, is seen as a business or not. Or if it's capital losses, if it's crypto capital losses, then we can use any sort of capital gain to offset with your crypto losses, if that makes sense. So no, crypto is not a portion in its own section. And same asset class, you don't need to do that. But yeah, we got to work out whether the loss is revenue or capital, and then follow those respective rules. No worries. Wouldn't the cost base of the NFT be zero initially before a market value is assigned? Yeah, so your market value may be zero. Yeah, and then on sale, you're taxed on that for whatever you get for it. Yeah. All right. Well, that's about it from me. Do you have any software you here for crypto tax calculations? So Joe, we had a few. So I don't recommend one in particular, but let me find the slide. I'll just pop it up again. So that's a list of a couple that we've seen clients use. All good. No worries, Joe. But yeah, that's the snapshot of what might be able to help. Sweet. Louise uses Coinly. Sweet. And yeah, Howard brings up a good point. So what I've discussed is relevant to trading shares or holding shares for the long term, like it is with crypto. So it's the same tax concepts, just applied to a different type of asset. Sweet. All right. Well, thanks for joining. Hope that's been helpful. Again, if you've typed SSS in the chat box, our team will pick that up and send you the next steps on that. Cool. Hope that's helped. And see you soon if you're a regular like Steve is.